Hello traders, Nick here looking at the week that just ended, 124. It ended with drama on Friday and not quite minus 1%. Apparently we haven't had minus 1% in the indices since last October. We did end up lower than more than 1% down on the small caps, which is a basket of 2,000 stocks. So I'm going to start with the VIX. It's a mystery to me, the VIX, as to how it trades. I was already long calls into a day where it spiked 10-12%, and I still didn't make money. So my calls are way out. I really bought them to capture a move like this. So they weren't scientific. I usually don't buy calls in the VIX or buy puts in the VIX for this reason. I remember trying it before. I use it for gauge, but I don't try to trade it. But one day I decided, what the heck? Way out in time in May, so all I need is one gigantic whoosh down in the market and it should be really green. But I'm surprised that I barely made any money on a day like today. But I am making a point here. So let's look at this. I'm going to bring a scratch pad. This is a point I made about Boeing the other day when Boeing, side note as I do this, had a debacle. What if the actual debacle was when they said, okay, so we're pushing our, the max is not going to fly until maybe the second half, maybe if that, or longer. So the stock fell to almost $300. I thought to myself, this is the new guy, the new CEO saying to the government, hey, it's in your hands. Sorry about all these other fake dates we've given. Please be good with us. And sure enough, today, on Friday, the government side, the FAA side, called airlines and said, hey, maybe we could get it up and running sooner than later. So they handed over the reins of the headlines from Boeing to the actual people that should be doing it, which is the agency. So I also learned that, based on CNBC reporting, yes, they're good for something sometimes, that a whole chunk, almost half if not more, of the money that China is supposed to spend under the new agreement, the Phase 1 agreement, is for planes from Boeing. So there's no way on earth the Trump government is going to let that not happen. So I have strong faith that the Boeing MAX will fly sooner rather than later, so I would not short Boeing. I would not short Boeing for that purpose. On the other hand, the Boeing, put that pin into it, it is a scary proposition. If it never flies, there's going to be tons of repercussions. So, okay, back to the VIX. Clearly it has a bottom, and 12 has been that bottom for a while. But my point today is for behavior. It seems like it has lower highs, and it bangs against the bottom, and then one day it just fires a warning shot, and then we get that. Lower highs, and then it fires a warning shot, and then we get that. I bet you I can go back. Okay, so we've had lower highs, and is this the warning shot? So this warning shot is as high as the one before it, lower than the ones before that. So here, you know, this warning shot, this is much higher than the ones before it. So it all depends on which one I'm looking at. The pattern, you know, it's not tradable. It's just part of the message of today. You know me, I've been bullish since 2800 or whatever, when everybody was, oh, we're going back to 2500 on the S&P. And I said, what are you shorting? We've got the Fed on our side, etc. So now that everybody was happy up here and everybody sure is going to the moon, there are no problems, boom, out of nowhere we get a, quote, scary day like today. So this is the S&P, and it looked scary because of how fast we've gone. So I did note that there's a support zone here just because of what happened. I'm looking left, 3,300. So today's low was right into that support zone. It's not concrete at all. But it is a stopping point. We climbed way too fast and way too systemically without any breather. I don't mind fast, but you got to check back to make sure that the footing is solid. So remember about here, I said, okay, we've got this and this line we're looking at, red. I drew this line way back then, like 8 or 9 days ago. Look at today's tick, you know, right there. So we're tracking the right levels, and also we had it as a tight situation back here. So all these lines come back into play. That's why I don't delete them until later on in time, and I consolidate them. So what now? Now is I don't start buying puts as it's falling. I should have been buying puts when I said let's buy some puts, starter positions, and those were green today. If I sold credit call spreads, those are green today. If I bought put spreads a few days ago, those are green. So it all depends on what I'm trying to do. If I'm trying to hedge my stocks, then I should probably protect what I'm protecting. But if I'm trying to, try to trade this dip, I should wait for a re-trigger of it. What does that mean? So if I'm doing it as a trade, I want to short the markets, I should find a level, okay, to short. So this is a 15-minute candle. So I wouldn't start shorting until we set a new low. So 32.80, which was the goal of today's drop. So midday, I was talking to some people. So this is the SPX. I'm trying to find the chart that I was talking about. Anyway, no, I can't. So the SPX flashed, and I said, okay, 32.80 through 32.60 is in play. So we are right there. So I wouldn't start shorting until we hit that a new low that triggers another set of selling. So the SPY had an open gap at 3.28 and 20 cents, 3.28, 20 cents ish. I think I'm 1 or 2 pennies off. Today's whoosh, halfway through the day, I was like, I wonder if they are trying to close it, and sure enough, they closed it by within hours. So if I'm looking at it, this is the S&P SPY. Everybody's seen the SPY. It's every candle is 1 hour. So I'm looking at it, and if you look, you can see a platform right here, and I put an arrow for another platform thereabouts. These are not hard line in the sands, but they definitely are zones. If I were to put a hard line in the sand, I would pick this one, 325. So this is intriguing to me. If we lose this, in fact, I'm going to do it here, 327 and change, I would say, uh-oh, because then that would look like an inverse cup and handle. This hump and then a smaller hump. So if this bounce fails, then they would be drawing out a right-hand shoulder or a handle of an inverse cup and handle. So they had this move, right, and they bounced today off the lows. We closed off the lows with CNBC. Then we'll come up with the caterpillar. That's what I call it. Or, yeah, ladybug. So then the drop will be somewhere down here. Joking, of course, but that's my ladybug, which is an inverse cup and handle. So if the bounce doesn't hold and they come back and set a new low, that's what I'm saying. If they set a new low, then we have another pattern triggering. Ideally, it should hit this zone here. And for that, I look at 325. Why? Because of this. What the heck is that? Right? And what the heck is that? So this zone to me is interesting. Halfway through is this, and guess what? This yellow line is the volume profile point of control. For this period of time, this line here, $323 and change, is the one where buyers and sellers were most active by a long shot. So all this was on frothy volume compared to down here. So how do I get these numbers? Just call the volume profile. It basically takes all these bars. These display how they happen in time. These bars over here, they display the same information, but where they happen on levels. On the way up and on the way down. And this tells me that this is the most active level, which is good news. It's almost acts like a magnet, but it's also support. Because if it falls here, if prices fall down to here, then whoever bought it and sold it, they say, hey, last time I bought it here, I made a ton of money. So they buy it again. So they're active. Machines trade consistently the way they trade. So this is the S&P, I think, right? Yeah. And then the Nasdaq held the strongest today and the week. I don't know if the Nasdaq week turned out to be negative. Let's take a peek. Oh yeah, red. So weekly, this is a weekly chart, S&P, SPY. Doji red barely by the Nasdaq, and very red on, you can't see it here, on the small caps. That's last week. The small caps were stars. And look, this candle, complete opposite of last week. So not too good there. Banks red. I'm jumping around, but you'll get the point. The message is the same. Cautiously optimistic. But I was bearish at the top when everybody was so bullish. So back to the Qs. The Qs had an incredible rally. And next week we have a ton of big names reporting. I mean, we're talking Facebook, Apple, Starbucks, a ton of them. So it is going to be a scary week. How much more can Apple move? Or what could management say to increase the enthusiasm in Apple more than is reflected in the chart? All this is the same message. Boy, they better nail these reports. This is Apple. On what planet this happens in Apple? Rarely. Apple's valuation is not expensive, but it is expensive relative to itself. It sells now at like 28 PE, I think, from memory, and like 6 times its sales. It used to be 4 times its sales in about 18 PE, and we always said, why is Apple always cheap? Well, it's no longer always cheap because now it's way expensive, 40% expensive relative to itself. Still cheaper than the other guys, or as cheap as Google and Facebook, for example. But believe it or not, Amazon is the cheapest of all of them, in my opinion. PE is high, but it sells at 3.5 times its sales. So they do have the sales to justify the high valuations because they're a growth company. I don't look at their profitability. I look at their growth, sales. So they are doing a good job there. So the message is next week is pivotal. Oh, and by the way, a little tiny thing called Federal Reserve decision on Wednesday as far as what they're going to do with rates. Nobody expects anything. But boy, God help us if they say something like, well, everything is hunky-dory now. We don't have to worry about cutting rates anymore. So banks might pop a little bit because then, rates rally a little bit and the TLT falls a little bit, but it's not going to change much. It's just rhetoric. But if they do come out and say something the opposite of what they said last year, which is we're in foot on the gas for a long time regardless of how high the inflation goes or wage inflation goes, God help the markets. So next week, flip a coin like 4 times, take the average of heads or tails, and then decide if it's going to be up or down. I really have no idea. Logic dictates that the reports have to be perfect, and I don't think they're going to be perfect. If I was a CEO and my stock is at all-time high beyond wildest imagination, this is when I say, you know what, I should be a little cautious here and, lower the bar a little bit. So Netflix this week made us some money on an incredible flip, the opposite of last time. Last time they spiked and they fell. This time they fell and then they spiked. So that was a nice, pleasant surprise, but they filled the gap. If you look left, which is crazy, right? They say, markets is, okay, you're confused with the lines, but here we go. Markets have no memory. I challenge that statement. Markets has perfect memory. Boom. Gap closed. So the alert went out as soon as we triggered here that this is some sort of a cup and handle. But then as soon as they took out that, then it became really interesting because now they started eating into it. And then even yesterday on the 23rd, I believe, there was another alert saying, hey, it's going to 360, get on board. And whoever bought those calls right away, it was a quick buck. It was a double at least. So, but it didn't last. So that had to be quick. That's my statement as to at these all-time highs, you can't just sit in your stance, in your trades, overstay the welcome, because on both ways, like down or up. Like today, if somebody started buying puts and they made money and they didn't book them, maybe they got a lot less money at the end of the day, and I definitely would not hold them as a trade for too long. So back to the point. People say, oh my God, today was so painful. Let me show you. I don't use this pattern often. It's called the pitchfork, these colors. It starts here, and it looks like a pitchfork. See the red lines? And then it throws a channel or two. I don't use it to trade. I use it for perspective. So we've been inside this ascending channel, and today's dip, we just touched the center of the tightest channel inside the pitchfork. So first of all, I'm not perfect at drawing pitchforks, but this looked pretty good to me. And just for perspective, this is nothing. If they want to correct, this is nothing. I mean, it looks like a lot, but it's not even 1% on the day. A minus 0.9%. So a 5% drop is, come on. Okay, doesn't want to do it. A 5% drop is easy if anything goes wrong. There we go. Jeez Louise. Okay, so this is 5% from wherever here. Just for visual purpose. Then would be at the bottom end of that channel. So do I expect a debacle? Not with these set of circumstances. Whatever they deliver on reports, it's not going to change the game. It's going to be a little better, a little worse than expectation. The game changer would be something like the Federal Reserve flipping bearish again. That's a game changer. Another one would be Trump out. That's a game changer. Or because he's got the deals going and he's the one causing it. Markets don't like change. If you change one of the basic assumptions, then they throw a fit until they get comfortable with it, and then it becomes the norm. And then you change them again, they'll throw a fit. So do I start long here? I don't. Unless I have a specific reason to. And it could be anything. So how about the TLT? Today it flashed breakout. Next week is binary for the TLT because of the Federal Reserve. Whatever they say, if it's bullish, then it's going to rally because rates are going to fall. If it's bearish, then it's going to fall. The bonds prices are going to fall because rates are going to rise. Because if the Fed is bearish, that means they don't want to cut rates, right? So if they don't cut rates, then the assumption is that rates will be rising. So how do I look at rates? The yield on the 10-year is TNX. So this would be the opposite of the TLT. Some people look at the TBT. They look the same, right? And they should look exactly opposite of the TLT. So this is the price of bonds, the 20-year. The other ones were yield. The TNX is an index, and it doesn't have options. That's why some people like to do the TBT because it has options. I believe the TBT is an ETF. So anyway, breakout in TLT, on paper it should get to 146. But next week is Federal Reserve, so whatever they say is a coin flip, just like earnings. So you can see how it traced out my upside pattern that I had drew for us perfectly. So if I'm long based on the breakout that happened and announced, then boom, this is where I book. Indeed, I shared a video, I believe, on being long the TLT, if not a video, a write-up also, for the whole year because of TINA, the notion that there is no alternative. So I sold put spreads or puts, depends on somebody's guts, for the whole year, or at least half the year. Like I gave specific examples for April, for May, for June. I can even go out to the end of the year. Bonds are not going to fall out of bed unless something major happens. And I mean like giant happens. Because for as long as Christine Lagarde on the ECB, the one that came after Draghi, is going to stick with zero or negative rates, money all over the world has no chance but to come and buy the U.S. bonds because the U.S. bonds still pay something. The 10-year pays 1.7% versus you buy a bond in Europe, it's going to cost you money. So you lend the government money, and as a thank you, they'll say, you got to pay us more money for the privilege to park your money in their coffers. That's insanity. That's the opposite of capitalism. That's insanity. Go to the bank and say, please store my money and I'm going to pay you for it. I don't want interest. In fact, I'm going to pay you interest for you to keep my money. That's insanity. I'd rather keep it in a mattress. So, for that purpose, TLT will have a buy to dip perpetually, in my opinion, until that changes. So, here's a weekly chart of the TLT. I'm going to take out all the lines for now. And you can see that it has supports. And 132, I looked at the breakout neckline, which was around 130-ish, and I said anything below that should be bulletproof as far as selling puts or put spread without a major change in the environment. Like Christine Lagarde saying, well, guess what? We're going to 1% on our bonds. That would be a considerable change, and the bond vigilante, I guess they call them, would be in business. Until then, the dips are buyable. The dips are buyable. How do I put that into money in my pockets? I sell put spreads on the dips. Or I sell them when I did that when it wasn't moving anywhere, and then now they're all at 60% or 70% of maximum gains, if not expired, worthless in my favor. So that's how I trade it without a lot of hassle. So I covered almost cussed, a crap ton of stuff here. But the message is the same. Turn off the TV and use logic. So I'm looking here. This was an inverse head and shoulder that had this target in mind. So I don't anticipate a huge run, but technically there was a trigger to 146. Next week, into TLT. Next week, it's binary because of what the Fed's going to do and say actually more so than do. On top of it, we have all the uncertainty of all the earnings. So the implied volatility in all these stocks is going to be very elevated. So one thing I do not do is I do not buy short-term options, because when I buy short-term options, I'm paying up for that volatility. So if I go to buy an Apple option for next week, a lot of the money I'm giving them is for the nervousness it has until Tuesday. Wednesday morning, that nervousness will go, will disappear, get cut in half, if not more. So if I paid $1, basically half of that dollar, should nothing else change, is gone. Just by way of the event is gone. So I do not buy short-term options. In fact, I would sell them. Like if I wanted to buy a call in Apple, I'd go out in time and I buy a call which is regularly priced as far as implied volatility, and I would sell one against it for next week to take advantage of that volatility. That would be the right thing to do. So those are calendars or diagonals. If you don't know what that is, message me. All right, so the message is it's not the end of the world. We've had one red day. This is the S&P. But that doesn't mean it's going to go on like it was crazy before. And because we have earnings. And I'm looking back at the chart. I don't know how they say it's overbought. I don't know how to quantify that. It's just toppy. Okay, I'm looking at the RSI is toppy. The behavior, the way it moves relative to its moving averages, it's just toppy. So the least I can say is admit this is not an obvious point of entry, even though we had a almost 1% dip on the day. So the buy the dip people, I get it. I'm on board. But it may be too early. So I don't start buying puts on this dip unless I'm protecting something specific. I do buy puts for a trade if they set a new low lower than today's low, because that opens the door for new patterns like we just discussed earlier today. So if I wanted to do anything, why don't I do this? Yeah, I'm eyeballing left. Okay, so maybe I'll put it here. So this wake me up when we go below 32.75, because then it may trigger a retest of this zone. Just an example. All right, hopefully there's a lot of talk, but I think it frames what I think of the markets these days. Nothing has changed. I'm not bearish markets. I'm bearish the price action, cautious of it. I don't buy it blindly. Like people that are buying Tesla up here, they have real good faith. Faith I don't have. So Tesla box is here. I'm going to say, okay, add an alert here. Ideally, if somebody wants to chase it, they should wait for a new high. Add an alert here. I'd be shocked. But this is crazy. All right. Not to pick on it. I just don't have, it's not an obvious point of entry. Can we all admit to say that? All right. Nick signing out.